Here's a man who turned down a job at Goldman Sachs, not because he did not get the offer, but because he thought the firm's culture would corrupt his judgment. He was 22 years old. And that decision, more than almost any other, explains everything that came after. Warren Buffett is now in his 90s. He has compounded wealth at a rate that over nearly 6 decades turned a failing textile mill into one of the most valuable companies on earth. From 1965 to 2023, Berkshire Hathaway grew its book value at roughly 19.8% per year, nearly double what the S&P 500 returned with dividends reinvested. That is not luck. That is a philosophy executed with almost inhuman patience. But here is the question that keeps serious investors up at night. What would that same young man do today? If that same mind, same discipline, same hunger woke up at 25 in a world of artificial intelligence and algorithmic trading and $12 a month brokerage accounts, what would he actually do? Because the tools have changed, the markets have changed, and some of the very conditions that made Buffett's strategy work no longer exist in the same form. This is not a story about whether Buffett was right or wrong. It is a story about what his principles look like when you strip away the era he happened to live in and rebuild them for the world you are actually living in right now. The core of everything Buffett built rests on a concept so simple it sounds almost too obvious to say out loud. Buy something worth more than you paid for it, and wait. That is it. That is the whole secret. The complexity is in the execution. When Buffett was young, finding undervalued companies was genuinely hard. You had to travel to headquarters, dig through physical annual reports, make phone calls, build relationships. Information was scarce, and the people who could find it and understand it had a real advantage. Today, that gap has nearly closed. The moment a company reports earnings, thousands of algorithms parse the data in milliseconds. Retail investors can pull up the same financial statements a hedge fund analyst studies. The internet did not just democratize information, it essentially made informational edges extinct for most ordinary investors. So if the young Buffett could not rely on knowing more than everyone else, what would he lean on instead? Almost certainly he would lean on thinking differently, not faster. Differently. That was always his deepest advantage, and it travels across any era. In 1999, at the peak of the dot-com bubble, Buffett stood up at a conference and said publicly that equity returns over the coming decades would be far lower than the previous 17 years. The crowd was unimpressed. The Nasdaq was still climbing, but he was right. And right not because he had better data, but because he was asking a different question than everyone else in the room. A 25-year-old Buffett today would ask the same kind of different question. Not which AI company is going to win, but what does the world look like in 20 years if AI becomes as foundational as electricity? And more importantly, what businesses will still be standing, still earning, still compounding, regardless of which specific technology wins? That shift in framing is everything. The technology question is almost impossible to answer with confidence. The business question, the durability question, is answerable. It always has been. Now, let us talk about the tool that would genuinely excite a young Buffett today, one that did not exist when he was getting started. The Exchange Traded Fund, or ETF. Think of an ETF like a basket you can buy with a single click that holds hundreds of stocks at once and costs almost nothing to own. In 2024, global ETF assets crossed $11 trillion. Buffett himself has said repeatedly that most people should simply own a low-cost index fund tracking the S&P 500 and forget about it. He put it in writing. In his actual will, he instructed that 90% of the cash left for his wife be placed into exactly that kind of fund. When the man who beat the market for 6 decades tells you not to try to beat the market, that is worth sitting with for a moment. It is not a contradiction. It is the most honest thing he has ever said about how hard his own method actually is. Over 92% of large-cap active fund managers underperformed the S&P 500 over a 15-year period. That number is almost offensive in its clarity. Most professionals with entire research teams and decades of experience cannot consistently beat a simple index. A young Buffett would look at that statistic and feel two things at once. Vindicated because it confirms what he always believed about patience over activity, and deeply curious because it raises a harder question. If passive indexing keeps growing, where does genuine mispricing actually live now? Buffett's entire method depends on markets being mostly right, but occasionally very wrong. He needs those moments of irrationality. And here is the uncomfortable truth. They still exist. They are just harder to find, and they tend to hide in places the algorithms ignore. Small companies, obscure industries, markets outside the United States. A 25-year-old Buffett, armed with today's tools, would almost certainly fish in waters that the big money cannot easily reach, not because he is contrarian for its own sake, but because that is where the math still works. US stocks in 2024 traded at roughly 21 times forward earnings. Emerging market stocks across Asia, Latin America, and parts of Africa traded at closer to 12 times. That gap, that discount, is the kind of thing a young Buffett would notice immediately. Valuation is simply what you pay today relative to what a business will earn for you over time. When you overpay, even for a great business, your long-term returns compress. When you underpay, even for an ordinary business, time tends to work in your favor. The math is merciless on this point. A 25-year-old today can open a brokerage account, buy a fund that tracks Vietnamese or Brazilian or Indian equities, and do it before lunch. That access simply did not exist a generation ago. The question is not whether emerging markets are cheap. The question is whether a young Buffett would have the temperament to hold through the volatility that always accompanies that kind of value. And the answer, knowing what we know about him, is almost certainly yes. Because patience was never a strategy for Buffett, it was a personality trait, one you can cultivate but not fake. Now let us get to the thing everyone wants to talk about. Artificial intelligence, because you cannot imagine a 25-year-old investor in 2026 and not grapple with it directly. So let us grapple with it the way Buffett would, honestly and without hype. Buffett avoided technology investments for decades, not out of ignorance, but out of what he calls his circle of competence, his clear-eyed understanding of what he could and could not predict with confidence. He could not forecast which technology companies would dominate in 10 or 20 years. And in tech, being wrong about the winner often means losing almost everything. But then something shifted. Buffett's firm built one of the largest positions in Apple's history, not because he suddenly understood software, but because he understood something deeper. Apple, by that point, was not really a technology company anymore. It was a consumer brand with extraordinary pricing power and a loyal customer base that bought a new version of the same product every 2 years. His firm eventually sold roughly half of that Apple stake in 2024, a decision that raised eyebrows. But read it correctly, and it is entirely consistent with his philosophy. Conviction in a company is not the same as conviction at any price. A 25-year-old Buffett looking at AI today would apply that same filter. Not which AI model is most impressive, but which businesses, because of AI, have just become permanently more profitable, more defensible, or harder to disrupt. That is the question that leads somewhere useful. There are businesses where AI functions like a reduction in cost. It makes their operations cheaper, faster, and more scalable without fundamentally changing what the customer pays for. For a business with already strong pricing power, that is a permanent lift to earnings. A young Buffett would look for those quiet beneficiaries, not the AI companies themselves necessarily, but the businesses they make more powerful. Let us slow down and talk about something that often gets skipped in conversations like this: the psychological dimension. Because Buffett's greatest advantage was never analytical, it was emotional. He did not panic in crashes. He did not chase rallies. He kept his judgment when everyone around him lost theirs. In 2008, when the global financial system was genuinely coming apart, Buffett wrote an op-ed in the New York Times telling Americans to buy stocks. Not because he knew the bottom, but because he understood that historically, the best time to buy is when everyone else is most afraid. That kind of composure is almost impossible to teach and almost impossible to fake under real pressure. A 25-year-old today faces something Buffett never had to contend with: the constant, relentless noise of financial social media. Every market move generates instant takes, hot analyses, emotional reactions. The signal-to-noise ratio has collapsed. In that environment, the single most valuable skill is not knowing more. It is caring less about the short term. Howard Marks, one of the most respected investors alive, argued in 2023 that the 40-year bull market driven by falling interest rates is likely over. What that means in plain terms: the rising tide that lifted nearly all investment boats from the 1980s onward cannot be assumed to keep rising. A young Buffett would hear that not as a warning to give up, but as a clarification of the challenge ahead. The game is harder. The edges are smaller, which means the principles: patience, selectivity, emotional discipline, the relentless search for value, matter even more now, not less. Berkshire Hathaway sat on nearly $189 billion in cash at one point in 2024. That is not timidity. That is the act of a patient hunter, someone who has loaded the gun and is simply waiting for the right moment. A 25-year-old would apply the same logic at a smaller scale. Waiting is a position. There is one final piece of this picture that almost never gets discussed, and it might be the most important of all. Buffett has always said that the most important investment anyone can make is in themselves, in their own knowledge, their own judgment, their own reputation, not as a motivational sentiment, as a literal investment thesis. A young person who deeply understands one industry, truly understands it, has an edge that no algorithm can replicate and no ETF can package. A 25-year-old who spends 3 years developing genuine expertise in healthcare data, or agricultural supply chains, or the economics of battery storage, that person sees things the broad market cannot see. Buffett spent the first decade of his adult life doing exactly that: reading, studying, visiting businesses, talking to people in industries he wanted to understand. He was not born knowing how to value an insurance company. He learned it obsessively before anyone was paying him to. So, we arrive back where we started. A young man, 25 years old, deciding how to engage with a world full of noise and opportunity and genuine uncertainty. The specific conditions that let Buffett compound at 19.8% annually for 6 decades, those conditions are gone. No one will replicate that exact path. But the thing underneath the path, the discipline to think independently, to value patience over activity, to invest in what you genuinely understand, and to hold your nerve when the world is telling you to run, that has not changed at all. It is still the only edge that cannot be automated away, cannot be indexed, cannot be copied by an algorithm running at the speed of light. If Warren Buffett were 25 today, he would not be chasing the hottest AI stock. He would be sitting quietly somewhere, reading everything he could find about one thing he wanted to understand better than anyone else. And then he would wait. And then, at exactly the right moment, he would act. The tools are different. The patience is the same. That is the whole lesson.